Ladies and gentlemen, Archivist here. If you are looking at the stock tickers on your screen, you are looking at a hallucination. If you are waiting for the cable news anchors to explain why your brokerage app just froze, you are waiting for a liar to explain a magic trick. Stop. Turn off the noise. The blinking red and green lights of the New York Stock Exchange are not reality. They are the scoreboard for a game that ended 3 days ago. The event you are witnessing right now, the event the mainstream financial press is frantically trying to label a glitch or a technical correction, is neither. It is an interdiction. It is a kinetic severing of the global nervous system. On the 16th of January 2026, two distinct realities collided. In the digital realm, the backbone of Western finance, Cloudflare and AWS, suffered catastrophic outages. In the physical realm, the Earth itself seemed to revolt against the supply chain, from the copper mountains of Chile to the gold pits of Indonesia. You are being told these are coincidences. You are being told that a server farm failure in Virginia and a landslide in Papua are unrelated. This is false. In the world of forensic intelligence, there are no coincidences of this magnitude. What you are witnessing is the synchronization of a digital blindfold and a physical strangulation. They turn off the lights so you cannot see them emptying the room. We are watching the simultaneous disintegration of the paper promise and the physical delivery. The system is not crashing, it is being dismantled. Let us look at the data that defies their narrative. Forensic data. Let's strip away the rhetoric and look at the autopsy report of the last 24 hours. Item 1. The digital blackout. On January 16, major infrastructure providers Cloudflare and Amazon Web Services went dark. The official excuse is capacity overload. This is a lie for the gullible. A capacity overload does not synchronize with a global margin call. This outage effectively froze the ability of retail investors and smaller institutions to liquidate positions or move capital. It locked the exits while you were staring at a 404 error screen. The liquidity was being drained from the system. Item 2. The physical force majeure. While the digital side was paralyzed, the physical side declared bankruptcy. The Grasberg mine in Indonesia, the largest gold mine and second largest copper mine in the world, declared force majeure following a massive landslide. Do not gloss over that term, force majeure. It is legal code for we are not delivering what we promised and you cannot sue us. Internal intelligence suggests a production collapse of 35% for 2026. This is not a dip. This is an amputation of global supply. Item 3. The Latin American chokehold. In Chile, the Mantoverde mine, operated by Capstone Copper, remains paralyzed by strikes as of this morning. Chile is the aorta of the global copper trade. When Chile stops, the electric world bleeds out. Item 4, the logistics inferno, an explosion in Utrecht, Netherlands, a tanker fire in Batam, Indonesia. These are critical infrastructure nodes. They are burning. When you overlay these data points, a pattern emerges that is terrifying in its clarity. The digital ledger is failing exactly when the physical asset is vanishing. The paper price is being rendered irrelevant because the mechanism to discover that price is broken and the asset that price represents is no longer available. The spot price of silver on the COMEX is hovering in the low $1.90 seconds. Yet, if you try to buy a silver eagle from the US Mint today, you found the doors locked. They ceased sales on January 14. Why? Because the spot price is a fiction. The real price, the physical price, is being discovered in Shanghai, where silver has already breached $100. The disconnect is total. The Western financial system is a car speeding towards a cliff, and the driver has just ripped out the speedometer so the passengers won't panic. The war thesis, the kinetic reality. The media calls this a supply chain disruption. We call it a siege. To understand the gravity of the 16th of January 2026, you must understand the concept of clearing the decks. When a superpower prepares for a total restructuring of the global order, they do not leave loose ends. They liquidate paper obligations and secure physical assets. We are witnessing a ring of fire tightening around global resources. This is not market volatility. This is thermodynamic warfare. Exhibit 1, the copper-gold nexus. Copper and gold are geologically linked. They are often found together. They are also economically linked. Copper is the nervous system of the future, energy, and gold is the collateral of the past, wealth. Both are being taken offline simultaneously. The strike at Monteverde and the collapse at Grasberg are not isolated industrial accidents. They are symptoms of a systemic failure of CapEx, capital expenditure. The West spent 20 years printing money to buy back stocks while starving the actual machines that dig wealth out of the ground. Now, the machines are breaking. Entropy is catching up to the printing press. Exhibit 2, the industrial panic. Look at the behavior of the apex predators in the industrial sector. Tesla and Samsung are no longer trusting the COMEX or the LME to deliver metal. Intelligence reports confirm they are bypassing exchanges entirely, negotiating direct physical offtake agreements with refineries. This is the end of the just-in-time global economy. Just-in-time works when you trust the shipping lanes and the dollar. When the dollar is weaponized and the shipping lanes are war zones, as we see in the Red Sea companies switch to just-in-case, they are hoarding. And when giants hoard, pygmies starve. Exhibit 3, the energy interdiction. The fires in Batam and the militarization of Venezuelan ports by U.S. forces are part of the same theater. The petrodollar died when Saudi Arabia refused to renew the 1974 pact. The U.S. military is now attempting to physically seize the collateral for a new currency regime, hence the invasion of Venezuela under the guise of counter-narcotics. Energy is the base layer of all economic activity. By destabilizing energy transit points, the cost of every physical good is being forced upward, regardless of what the interest rates are. This is a war of attrition. The paper market is leveraged 1-0-0 to 1. The physical market is absolute. When the paper shorts are forced to cover, they will find the vault is empty because the Chinese export bans of January 1 locked the doors and the mine collapses of January 16 swallowed the key, the bag holder. State-level conspiracy, who is trapped? You might think it is the retail investor with his crypto wallet frozen by the Cloudflare outage. He is merely collateral damage. The real bag holders are sovereign nations. The bag holder alliance consists of the G7 allies who foolishly believed that U.S. treasuries were a risk-free asset. They are now holding debt instruments that yield negative real returns in a world where gold has breached $4,600. Japan, the United Kingdom, the Eurozone. These entities are the bag holders. They are contractually and politically obligated to hold dollar-denominated debt, while the issuer of that debt, the United States, actively destroys its purchasing power. Consider the events at the Federal Reserve. The Department of Justice is investigating Jerome Powell. The independence of the Fed is a myth that has been publicly executed. This signals to every central bank governor in the world that monetary policy is now dictated by political survival, not economic prudence. The bag holders are also the Western bullion banks. JP Morgan Chase is rumored to be sitting on a $4.8 billion unrealized loss in silver derivatives. They spent decades suppressing the price of metals to prop up the dollar. Now, they are caught in a naked short. They sold silver they do not have to people who are suddenly demanding delivery. The outage of the digital infrastructure on January 16 was a gift to these banks. It bought them a few hours of darkness, a few hours to settle contracts in cash instead of metal, a few hours to change the rules before the lights came back on. But the most tragic bag holder is the Western consumer. The Costco stampede, where inventory sold out in 4 seconds, proves that the herd smells the fire. But they are too late. The premiums on physical silver have already reached 70% in secondary markets. The unit bias has kicked in. They cannot afford gold, so they panic buy silver. They are trading worthless fiat for the only affordable hard asset left, but the window has already closed. The U.S. Mint has already shut its doors. The protocol, resource denial. We are now operating under the resource denial protocol. The rules of engagement have changed. The previous strategy of buy the dip is a suicide pact. The new strategy is survival. If you are still holding paper contracts, ETFs like SLV, or unallocated pool accounts, you do not own metal. you own a claim on a bankrupt counterparty. Here are the directives for the current operating environment. Directive 1. Assume zero delivery. Treat every digital promise of physical delivery as a lie. If you cannot touch it, you do not own it. The disruption at the mines and the force majeure at the refineries mean that the supply chain is broken. It will not be fixed in weeks. It may not be fixed in years. The industrial giants like Samsung are front-running you. They will get the metal. You will get a force majeure notice and a cash settlement in depreciating currency. Directive 2. Short duration, high friction. Get out of long-duration government debt. The U.S. 10-year Treasury yield is oscillating violently because the market cannot decide if we are facing deflationary collapse or hyperinflationary spending. It does not matter. Both roads lead to the destruction of bondholders. Move capital into high-friction assets, assets that are difficult to confiscate and essential for life. Energy, food, bullion. Directive 3. Monitor the Shanghai premium. This is your only true compass. Ignore the COMEX price. Watch the Shanghai Gold Exchange. The spread between Shanghai and New York is now over $15 for silver. The spread is the fear gauge. As long as this spread exists, the arbitrage will drain every ounce of silver from the west and send it to the east. When the spread widens, the bleeding accelerates. When the spread becomes infinite, the dollar has failed. Directive 4. The minor option. With physical metal disappearing, the next best proxy is the unhedged miner. Companies like Fresnillo or Hochschild, yes, they face labor strikes. Yes, they face operational risks. But they own the ground. In a world of paper counterfeits, the man who owns the hole in the ground becomes the king. But be warned, this is not an investment. It is a leverage play on chaos. Conclusion. The phase shift is accelerating. The events of the 16th of January 2026 are not an anomaly. The digital outage and the physical shutdown are two hands of the same strangler. The system is clearing the decks. It is shedding the dead weight of paper promises to save the core of physical value. You are currently positioned as dead weight. The US Mint is closed. The mines are striking. The servers are down. The message from reality is clear, even if the news anchors refuse to say it. The exit is blocked. This is the archivist, the resource denial protocol,